morning, everyone. Let us start a new unit today, that is Unit 8, Absorption and Marginal Costing. Okay. So I hope the screen is visible to everyone and I am audible. Can someone quickly confirm that? Fine. So, have you all heard of absorption and marginal costing before? Yes. Till now, have you all studied about absorption and marginal costing in any paper as of now? Or this is the first time you all are hearing about these methods, absorption and marginal? Okay, probably the first time. So these are two methods of costing or arriving at the cost of any product or a process. Fine. The main difference between absorption and marginal costing is the way you treat the fixed production overhead. I hope everyone has watched pre-recordings for this unit. Can you all confirm if you all have watched the pre-recordings? Because I've covered most of the theoretical part of it in the pre-recording, so I just want to confirm if you know about this or you've not watched the pre-recordings. Okay, you have not watched the pre-recordings. From next class onwards, please watch the pre-recordings before you enter the class, because it will give you a proper balanced view of the lesson. Fine. Now I'll cover the theory in brief for whatever is required for the sums. The rest of the theory, you can go and watch it in the pre-records. Okay? Works well? So, the difference between absorption and marginal costing is, in absorption costing, whatever is a fixed and variable production overheads, you will consider it for the cost of every unit. Okay? Fixed cost also you will assign to every unit. Variable cost also you will assign to every unit. But in marginal costing, what you'll do is only variable you will assign. Fixed cost, you will not give it to every unit. What you'll do is you will deduct it entirely from the profits as a periodic cost. Periodic cost means, see, rent, if you are paying for a period of 1 year, you will not include rent in the inventory valuation or rent in the cost of sales. Okay, rent is fixed. You will deduct it from the profit towards the end as a periodic cost. So this is how marginal cost is done, where you don't consider fixed cost, you treat them as periodic cost and deduct it from the profit at the end. So in marginal cost, you are talking about what is the cost I will incur in case I produce one extra unit. You are not thinking of the cost which you will anyways incur, like your fixed expenses. Okay, what do you want me to repeat? The marginal cost. See, the marginal cost is nothing but, you are thinking you will produce one extra unit. Okay. If you produce one extra unit, what is your excess cost? Okay, difference between marginal and absorption cost. Fine, great. Now in absorption costing, what you'll do is fixed production and variable production overhead, you will include it in your cost of sales. I will show you the pro forma for statement of profit and loss. You will understand it better over there. Here, just understand that under absorption costing, fixed and variable production overheads are included in the cost of every unit. Under marginal costing, you're only considering variable production overheads. Fixed production overheads, you're thinking anyways it is fixed, anyways I am going to incur. Why should I include it in the cost of every product? I will deduct it from my profits at the end as a periodic cost. Okay. Now marginal cost. Coming to marginal cost, you are thinking if I produce one extra unit, what is my extra cost? That is the marginal cost. So what are the costs incurred if you produce one extra unit? Only the variable costs, right? Fixed costs are anyways fixed. You produce one less unit or you produce one extra unit. It is fixed. So marginal cost, you will arrive by adding your direct material, direct labor, direct expenses, and other variable production overheads. This is very useful for short-term decision making. Quickly, if you want to make a decision about what is going to happen if I do a change, then only what is extra you can think of it. So please note down this marginal costing statement of profit and loss. This is how your statement of profit and loss will look under marginal costing. So you will have sales. From that, you will deduct cost of sales. Cost of sales is calculated as opening inventory plus your variable cost of production, though it is fixed cost of production, you will not include here, and deduct closing inventory. From there, you will deduct other variable costs, okay, and arrive at your contribution. I'll explain what is contribution. From contribution, you will deduct the fixed cost, which you anyways have to pay. You will arrive at the profit or loss. Is this understood? Be quick, we have sums lined up. We have to solve sums and make statement of profit and losses under both the methods. Okay, so please be quick in noting down. See, you will add fixed cost in case you are adding it in the cost of sales, right? Finally, you are deducting it. See, whatever you are doing, you are deducting the cost of sales from the sales. So, within that bracket, you will add, and finally, the entire amount you will deduct. So, if you are deducting it separately or you're deducting all together, it is the same. You're telling over here, normally, you're adding variable cost of production. So, otherwise, you would have added fixed cost here, right? So, even if you add or deduct, this entire thing you're going to deduct over here. So, if you're adding it here, you're deducting. If you are not adding it here, you're deducting from here. So, anyways, the costs are deducted. Okay? Did you understand why I have deducted? You add fixed cost over here to know your cost of sales, which you will ultimately deduct. I hope you all have noted it down. Can I proceed? We reached contribution over here, right? Sales minus all the variable cost is contribution. Okay. So contribution means how much money you have by selling this product to pay your fixed cost. So because it was separated as fixed and variable, contribution is equal to your sales price minus total variable cost. Contribution per unit is sales price per unit minus total variable cost per unit. If you have total contribution, if you have contribution per unit and sales volume, you can multiply to reach the total contribution, and profit will be equal to total contribution minus fixed overheads. Okay, these are certain formulas. Note it down, we'll use it in our calculations. Okay, you'll understand these formulas better once we solve sums. I have a sum lined up, so please note down this contribution formulas and let me know once.